Here to talk more about the Fed and the stock market, Joe Tegay of Equity Armor Investments.
Thank you, Angie, and we'll be watching the market today as it's the second day after the Fed. Sometimes the market takes a couple days for everything to really cycle through to kind of fully understand and grasp what the Fed's actions will mean around the world and, of course, domestically. But what happened yesterday with the Fed is, number one, they said interest rates are going to stay low for a very long time. Number two, they said that they're going to increase their bond buying program. And number three, they gave a 6.5% negative outlook for growth this year, reaffirming that the economy is very bad. And seemingly bad news, again, is good news for the market. And the biggest winner, the Nasdaq, of course, as it has been with these low rates and this bond buying program, people are flooding money into the Nasdaq, willing to pay a very high PE multiple because they know those companies will be able to put that money via the bond market to work, borrow at a lower rate, refinance, and use it to either buy back their stock or go out and acquire companies or grow themselves organically to be able to justify that high PE. Now, interesting, a week ago we saw great jobs data and the rest of the market did better. The broader economy was outperforming on Friday. The unemployment rate wasn't as bad as expected. We saw the S&P and Dow doing better than the Nasdaq and rates going the opposite way. Now today and even ahead of the, Wednesday and even ahead of the Fed meeting, we saw the Nasdaq outperforming, we saw yields going lower, and the rest of the market struggling. Of course, with all this liquidity out there, with rates lower for longer, it's going to be good for the broad equity space, and they're going to like it. Now, that said, given the fact that stocks have a higher PE now, and investors are willing to pay that multiple, it's going to lead to more potential volatility. That means there's a higher bar for these companies to get over. If the economy is slower than the Fed projects, negative 6.5%, or it's projecting 5% positive for 2021. If the economy doesn't match that, or these companies don't perform, it's going to lead to more volatility. So I think equity prices being higher and volatility prices being higher is what we have for the rest of the year. For Equity Armor Investments, I'm Joe Tegay.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.